Good afternoon, everybody, and thank you for joining us on the State of Tech in Africa 2024 report, also TR report webinar. We're very excited to have you all with us and also sharing the stories through the ecosystems for 2023. So to start off with, my name is Daniel Bitboy. I am the program manager and business development lead at AfricArena. And I just really want to give you a bit of an overview of who we are, what we do, and like what we're up to in 2024. So essentially what AfricArena is that we're an ecosystem building platform. Our vision is that we want to become the premier platform to accelerate African tech ecosystems across the African continent. So the way we do that is that we connect founders with investors, corporates. We do a lot of foreign market capital marketing events where we try to bring in more foreign capital into the country. We try to strengthen international traction on the African continent. And then also in its entirety, we also try to promote the African tech ecosystem and the opportunities that we do have for future and prospective investors. AfricArena's journey, we started all the way back in 2017. This is our 8th year in addition. So since then, we've kind of done about 15K of attendees digitally and over 800 founders who have pitched at an AfricArena event. We generally acquire about 1,500 plus startup applications. We've distributed about $3.7 million in grants and benefits. And then at the end of the year, we bring about 70 of the best startups to Cape Town, network of 230 plus investors. Essentially, what AfricArena is that we've got 3 added value pillars: brand communication, impact, and most importantly, market intelligence. So our ecosystem DNA, a lot of people know AfricArena for our strong events that we host across the African continent and abroad. But essentially, we do an array of ecosystem building activities on the continent. Our 4 main core mandates is that we focus a lot on service, product, community, and education. Some of this is that the first part is that we have Africa Rise, which is our acceleration program. In this place, we run Founders Bootcamp, which focuses a lot on investor readiness courses, pitch deck IR training, and then also deal support. We do open innovation programs with corporates, VCs, governments, and various institutions, where we then run and we facilitate pipeline management. We also facilitate sourcing new leads and also co-investment opportunities. Other products that we do with our incubator, which is the French South African Tech Labs, is that we run soft landing programs and ecosystem learning expedition. We also have a product that we've started in 2020 and in the past couple of 3 years called the Wired platform. So this is our investor portal. All of our pipeline that startups who have pitched at AfricArena event are showcased there. So you can literally subscribe there today. You can go onto the iOS store or you can go onto the Android store and you can go download. It's called AfricArena Wired application. And from there, you'll be able to apply and then also get access to our entire network of startups that we've showcased at AfricArena. We then also have a VCN conference, which is powered by the Digital Collective Africa, and also our venture firm, which is Africa Rise Ventures, which is a bridging round from seed to Series A startups. Also this year, our first event on the roster is going to be taking place in April. So from the 23rd to the 24th, we'll be doing a SaaS, a deep tech, and green economy summit in Joburg alongside AFCA. So definitely any people who are very keen to participate or are keen to get involved with AfricArena, like you're more than welcome to reach out to me or the team. We're very excited to kind of have you guys there and onboard you and join us in the journey in Joburg. So you can either contact Christoph, Kosi, or myself. So maybe to move on, I'm going to hand over to Kosi, who will then further chat a bit more about the Digital Collective Africa and the other properties that we do at AfricArena.
Showing on the stream.
Here we go.
Yeah.
Okay, it seems like just having some technical issues.
No. Afternoon, everyone. My name is Kosi Leballo, and I'm the investor relations at AfricArena and the coordinator at Digital Collective Africa, which is really what I'm here to talk to you about today. We are formally the NPO arm of AfricArena. But first and foremost, we are a community of investors, incubators, accelerators, and founders. We come together to identify and address challenges in the ecosystem. We do this online and in person. Online, we have a WhatsApp group where we coordinate ourselves. We also have our DCA website that's home to our outputs, and it's an open source resource platform. In person, we meet at our VC on here we come together, usually at a beautiful landscape of Mother Nature, and we discuss topics, the eventuality of which is to come up with toolkits, reports, and materials that we disseminate on the website, through our startup boot camps, through our partners and participants. We have one such event coming up in Johannesburg in April. And at this event, we come together. We'll have about 40 plus VCs, LPs, GFIs, and angel investors. It's a 2-day exhibition. In the Joburg one, we'll be exploring topics such as hurdles in fundraising, best practices for debt financing, a playbook for navigating the foreign capital investment and building co-investment relationships.
Thank you so much, Kosi. So maybe to move on, we're getting to the cream de la cream part of our report. So first of all, we're going to be doing a little bit of an overview of what we've been writing. So it will be myself, Business Development Manager at AfricArena, Dan Mavielas, who's Head of Product at AfricArena, and then Kosi, Investor Relations Lead at AfricArena. Thereafter, we'll also be deep diving a little bit more into those reports with our amazing panelists who will then be disseminating a bit later. So I know that's like the cream of the show. So maybe to start off with, in the beginning, something that we do in our State of Tech in Africa report, the purpose of this report is not necessarily to deep dive into the numbers and to the stats, but it's more about looking at the stories on the African continent, the stories that kind of make the bulk of what we're actually trying to achieve as we ecosystem build throughout the continent. So maybe to start off with the overview, there's 3 major reports that we use in our report methodology. So we take a look at the big deal, Brighter Bridges, and Partech. As you can see, the first question when you actually take a look at the analysis is based on the funding. So you see that in the big deal, they've put down $3.9 billion raised throughout the entire funding cycle of 2023. Brighter Bridges with 4.1 billion and Partech taking a look with 3.5 billion. So the question is why? So this is a little bit of an overview of what is the differences between the reports and their report methodologies. So when you look at the big deal, Brighter Bridges and Partech, the first question is what deals do they track? So this will kind of leads to the differentiator between the numbers and why you see such a large gap of a couple of millions. So within the big deal, you'll see that they only focus on equity grant and debt deals versus Brighter Bridges. You see that their primary sources take a look at public and disclosed deals. Secondary sources are public directories, media articles, company announcements, and then company websites. When you take a look at the Partech report, they only take a look at only equity and debt rounds that are about $200K or above. This means that their focus is on late seed plus to growth stage equity and debt rounds. So, I mean, this is why you'll see a little bit of a differentiation between the numbers. Then also geography focus, very important. You'll see that in the big deal, they exclusively focus on Pan-African and non-African headquartered companies with about 80% to 95% of their staff outside of Africa and their entire management. Where in retrospect, you look at Brighter Bridges, their coverage is limited to the primary African HQ of the company, and it's worth noting that they also take a look at other deals of companies that are headquartered in Africa, but also have an international team. Where versus Partech, you'll see that African startups whose main market is within the continent, even if they expand globally. So that's kind of just taking a look at the differentiations between the reports and just to explain like why there's different deal volumes or different numbers when it comes to equity, or taking a look at how they value their numbers. Another quick overview is also reevaluating the way that we view numbers on the African continent, something very interesting between the 3 reports. So here's a little insert of Brighter Bridges, Partech, and then also the big deal. So you'll notice that they each have different numbers. You'll see that when you look at equity deals, the numbers and the positioning of the continents are slightly different. So you'll notice that South Africa has a deal volume of like 83 deals, but in this numbers, you'll see that they had the highest equity funding round, followed by Nigeria, then Egypt, then Kenya. But if you actually look at the debt numbers, you'll then see that there's a different positioning on where you actually put the countries in a different order. So then you'll see that Kenya's first, Egypt, South Africa, and then Nigeria, which is very interesting. But if you take a look at the total funding with equity and debt and you put them together, you'll notice that the numbers kind of lean a bit more towards the debt numbers. So the positionings will stay the same. it's kind of interesting to kind of reevaluate and take a look at the numbers and see like how debt is influencing the way that we're actually looking at future and follow-on investments. Maybe just to continue, I'm going to hand over to Dan, who's going to do a bit more of an overview of the African tech ecosystem in 23. Over to you, Dan.
Thank you so much, Nate. Hi, everyone. So like Nathaniel said, this year was very interesting because we saw a kind of shift between the big four and their positioning. And if you look at the data, we had compared between the big deal and Partech alongside broader bridges. And on these graphics, you really wanted to focus first on the big deal just to try to understand how the deal had progressed. And it was, I would say, specifically a good year for the big four, arguably, because they amassed a total of 80% of Africa's startup funding overall. So it's actually a big dominance. But if you kind of zoom in the different ecosystem to try to understand better how these numbers kind of make sense, if you look at first at Kenya, Kenya has been really dominant in the Eastern Africa's region. It had 86, it moved actually from 86 to 91 of the total funding in 2023 compared to 2022. And notably, 93 startups in Kenya raised $100K or above. And when you look at the ecosystem, the appeal, or actually the tech hub, especially in Nairobi, when you look at it, a place where you have giant tech like Google, Microsoft, Samsung integrated there, and the ease of doing business in this region specifically kind of open doors to more investors to come and invest in the region. So that makes it very attractive, which kind of explains the numbers and the dominance. And this year, what we have seen is notably move from
and if you zoomed in really close, you'd see that it's made up of two parts, one with tiny hooks and the other with tiny loops. When the Velcro is pressed together, these tiny...
Thank you very much. All right, so if you look at, in terms of the moves of the government, there's been a lot of moves in terms of the startup bill that will be signed this year, creation of a Kenya National Innovation Agency. So many of the moves that the government is doing to make sure that the startups have funding. So now, if I move straight to the second ecosystem, just to go very rapidly, if you look at Egypt, it had also a very decent year and kind of had the upper hand on the Northern African region. And this is explained basically also by the first, the rise actually of one particular startup, MNT Alan, and coupled by different challenges that you have seen in Algeria or Morocco, whereby Egypt had made more in terms of deals. And a crucial driver when you look at Egypt is actually his graduates, 300,000 graduates per year, very dynamic, very youth population. So that really drives the innovation within the country. But it's not to say that it has faced various challenges this year, including the challenges in terms of the currency, which has been devaluated. So all these factors, the government is trying to find solutions for the startups so that they can have access to more funding. Now, if you move now to South Africa has notably been the best ecosystem in terms of standing strong, meaning that they were quite stable in terms of funding their raise. They actually expanded, they actually increased by 8% from last year. And this can be seen by increased government investment, growing number of successful investors, more mature fund investing in local startups. So all these factors can explain also why South Africa has been really resilient in the African ecosystem overall and occupy, according to the big deal, the third position in terms of ecosystem value this year. Now, at last, we zoom at Nigeria, where in 2023, it experienced significant shift. As you might have seen in West Africa, there was a lot of hiccups in terms of the startups. So you could see also that in terms of the US, there was less and less attraction to invest in the local startups. So you have seen a bit of a decline, of course, according to the big deal in terms of funding, but it is still the most mature ecosystem in the African continent. And with various interviews that you will see in the report, such as with Optera Capital, you understand that in the ecosystem itself, they really focus on investing on their own startup and developing more program incubators and accelerators. Now, if we move to the next slide, one particular thing that we looked at in the report this year that has made a shift is the Francophone African ecosystem. So we have seen that the Francophone African ecosystem overall has been really increased, this year, with a significantly increase of 15 of the total equity in the African continent. So outside of the big four, actually all the startups that were in the Francophone African ecosystem raised more funds than the English-speaking countries in Africa. So there is a lot of attraction. There's also been a lot of discussion with different funds that have highlighted that the currency with its stability is also one of the factors that attracts more investors into the region. So that's something very noticeable that we can also see in the report that we have that we're about to publish. So if you move to the next slide. Now look at the sector rapidly. Nothing has really changed since last year, just a move in terms of percentage of funding. But we can see that fintech is still dominant in the ecosystem with 41% compared to 37% in 2022. And we also see that energy is coming actually to a rise because they have doubled from last year. And we also see more and more funds focusing on the sector itself. So more and more funds are raising specific funds for energy, clean tech, and similar tech sectors. And then at the third position, you have logistics that has been dominant, but a small rise that we have seen in the health tech sector, moving from 3% to 6.5%. Next. And at last, a look at diversity. Female-led startup is still very low, but we can see that it has kind of doubled from last year, 7% this year compared to last. But still a lot of efforts to do in this particular category, because we have to help female founders raise more and more, and we see that the male-led startups are really dominant in this ecosystem that is Africa. So yeah, and now I will hand over to Kosi, who will take us through an overview of the prediction for 2024. Over to you.
Thank you, Dan. Our model is informed by the analysis of this report and our partner reports, as well as the information we collect during our tours and our engagement with investors, founders, ESOs, GFIs, and all the players in the ecosystem. As we correctly predicted in our 2023 report, we saw a decline in equity and debt funding last year. There was reduced investment from the US and high interest rates against weak currencies on the continent. We also saw a lot of defaults, especially in Series A and Series B. While it's a bit difficult to have a solid forecast because of the geographical developments we're expecting this year, including elections in the US and a lot of African countries, we foresee that interest rates will only reverse in the second half of the year, while our currencies still remain under pressure. As we release this report, our forecast says that in 2024, we'll see a flat to moderate rate of growth between $4.2 billion to $5 billion in total investment, while equity and debt financing continue to remain flat until Q2. This forecast is also informed by new funds being raised We're seeing a second fund for pod tech and new players such as Low Skin. There's a demand in capital. We're seeing capital intensive sectors such as climate and energy also increase. And we'll see more participation from the US and corporates. We're also forecasting more M&As and innovation on the continent. We see that in 2025, we'll have a $7.5 billion US investment, a 35%, 50% rebound growth that we think will extend into 2026, and possibly investment exceeding 10 billion in 2027. Now, while these figures are sounding positive, it's important to highlight that the continent is still only seeing 1% of the global VC funding, and at $3 per capita. Our overall forecast is informed by more initiatives from the US, the UK, Europe, Japan, and South Korea towards the continent and the ecosystem, more corporate involvement and acquisitions, more exits and IPOs at angel investor stage, and increased valuations, especially in West Africa and North Africa, as well as regulatory reform that we forecast will also contribute to the positive growth in 2024 and beyond. If I can hand over back to Nate. Thank you, Nate.
Perfect. So that wraps up our segmentation of the wrap-up of the report. We're now going to be going into the cream de la cream, what everybody's been waiting for, the amazing panelists that we're going to be sharing their perspectives on 2023, but also kind of giving a bit more of an overview of what to expect in 2024. So on the panel, and I'm just waiting for Dan and them, just as a reminder, there we go. Just as a reminder, if you guys want to, we're going to be launching the report right after this call. So it's going to be available on www.africarena.com. There will also be a QR code at the end of the session for you to scan if you want to read it. But I'm going to hand over to the amazing moderator for this awesome panel, the Satia panel that we've been waiting for, Nathan. So Nathan, I'm going to let you introduce yourself and then also just give a bit more context to today's conversation.
Cool. Thank you, Nathaniel. I'm super excited to be here, and hello to everyone that's tuning in. I think we have people from all over Africa and some international viewers, which is incredible to see. Firstly, thank you to the AfricArena team for hosting this panel and producing the report. And I can say that from being an early stage entrepreneur and founder, the challenges that were presented in the report, I can definitely resonate with. And also after interviewing more than 50 founders last year, towards the end of last year, it was very evident that the challenges were faced by all of us. And today, joining me on the panel is an incredible lineup of professionals just doing amazing things in the African tech ecosystem. But also before I introduce them, I'd like to just set the intentions for what's to come in this panel. We will be discussing 4 main topics, and that will just include strengths and weaknesses of the ecosystem in 2023, challenges and lessons learned during a very difficult period, sectors that experienced the most amount of growth, and also what investors can expect in 2024. I'm also going to let the panel introduce themselves and just give a quick introduction of who they are and what they do. And I think I see Dario. So Dario, could you please start?
Sure. Well, happy New Year, everyone, and good to see you guys. This is Dario. I run a company called Brighter Bridges, and we have been building an intelligence platform and research firm focused on Africa. Latest news being we have been expanding towards Latin America and Asia, and we'll be soon providing content about it. Very happy to be here, and I'll be discussing the findings of our end of the year report.
Thank you, Dario. Karen.
Thank you. I think today is the last day of the year that you can say Happy New Year. So Happy New Year to everybody. And good morning, good afternoon, good evening, wherever you're dialing in from. My name is Karen Serem Waithaka, and I'm the Chief Investments Officer for Catalyst Fund. At Catalyst, we are climate tech investors focusing on early stage startups in Africa that are building resilience for climate vulnerable communities. So we invest across different pillars, fintech, ag tech, aquaculture, essential services like waste, water management, primarily within the climate tech space. It's a pleasure to be here. Thank you.
Thank you, Karen. Igosa, it's nice to see you.
Yeah, hi, my name is Agosa. I manage Echo VC, where seed and early stage venture capital firm focused on tech and tech-enabled startups, and based in Lagos and Nairobi, and glad to be here.
Cool, thank you. I think we are waiting for Dr. Ola Brown, but maybe we could just go ahead and start the discussion while we wait for her. So my first question is around the strengths and weaknesses for the African tech ecosystem this past year. And maybe Dario, if you could start, I know that you wrote the report in your company, Brighter Bridges. So if you could maybe walk us through some strengths and weaknesses of last year.
So I think one of the things that we try to highlight on the report is try to offer a perspective that is not necessarily like things are going well, things are going badly, and really trying to contextualize an ecosystem that basically comprises of over 50 countries, even though obviously we know that there are only a handful of countries that are already capturing the bulk of the funding, but most importantly, an ecosystem that comprises of thousands of companies that are getting funded and thousands of investors and ecosystem supporters that are playing. And so boiling it down to numbers growing or decreasing could offer only a partial perspective. Now, strengths and weaknesses. I think I would start by saying that the last 10 years have basically seen the ecosystem go from basically non-existence to an ecosystem that is capturing quite a few billions of dollars flowing into the market every year. And I think for most of the people that have been operating over the past decade, this has been very tangible, even without looking at the numbers. You just need to look at how many people participate in conferences, how many conferences are coming up, and how many events and how many roundtables and how many new names are entering the space. So I would say that strengths, most of the indicators over the last decade have grown. So number of transactions per year, or roughly have grown. Obviously, like I'm someone who thinks that it could be problematic to gauge a market on a year-to-year basis, because there could be a year that for a number of reasons the transaction may be lower, but then when you look at that in a 10-year perspective, you realize that actually that was just a short-term anomaly. So for instance, the number of deals, the number of transactions have grown, the number of organizations that specialize in specific sectors have grown, the diversification geographically has grown, the number of financial instruments that are now available to entrepreneurs has grown. And we could say that aside from the spike that we've seen after COVID, the numbers have been growing. Okay, like one of the sentences that stands out in the report is that 2023 funding was still multiples of 2017 funding, right? Or 2018 funding when Brighter was founded. And this is 5 years, right? 5 years is barely the duration of a fund, right? So as much as the investors do not expect returns within a year, we cannot expect that a 50 plus country market can deliver results within a year or two, especially not quarterly, right? So these I would say the strengths. The weaknesses, I think there's a very high reliance on overseas capital, especially at LP. I mean, at LP levels, of course, but also there's still a very high percentage of overseas investors that are not based on the continent and actually determine the fund big deals. Now, this is a double-edged sword in the sense that, of course, when a company scales, they attract international investors. So there's nothing out of normality in here. But the fact that as soon as the global market dried up because of the market swings, the capital for growth stage company also got so reduced in Africa. something that should probably raise a few questions and get to think about the longer term sustainability of the ecosystem. But I am overwhelmingly positive about the state of the market. There was a moment where a lot of companies took advantage of the fact that there was a lot of cash in the market, and some of these companies are now paying the price of it. Doesn't mean that they deserve to shut down. And we never wish to ever any founder to have to lay off their team, but it might means that they need to resize this level of the scale and the growth trajectory that they have. Sorry, I'll stop here because I've been talking 10 minutes.
Cool. Thank you, Dario. Thank you for that. Karen, and being the Chief Investment Officer at the Catalyst Fund, have you also noticed the same weaknesses that Dario was touching on with that over-reliance on international investment?
Yes, absolutely. And I think when I think about the weaknesses and how to tie into what I think the strengths are, the over-reliance on international investors means that anything that happens, especially in the US, for example, has a very clear and direct impact into our economy in Africa, in the different countries in Africa. A simple change in interest rates in the US, which then had a global implication in 2022, then trickled down into Africa by 2023. We had such a high in 2022, and it seemed almost artificial, which, you know, we realized then in 2023 that it was actually a bit artificial. But then trying to diversify our funding sources and looking at, for example, South Africa, which is a really good example of a market where they do actually tap into local investors, local corporates, are very active within the VC space. And so in terms of having that impact when the international markets are not going the way that they should, there's a buffer from that perspective. So in terms of that weakness, it ended up leading to the funding. I didn't want to use the word winter today, but yes, it led into the funding winter, especially for growth stage companies. But that also then created an opportunity in terms of one of the strengths that I saw, especially in 2023, which if you look at it even from 10 years back, for example, when a startup is pitching and they say, you know, my exit opportunity is either I'm going to get acquired or we're going to merge with another business, we knew that it was more like a pipe dream, like talking about an IPO, for example. But then now in 2023, you could see a lot of M&A activity, both for expansion purposes. Look at Turaco acquiring Microinsure, looking at InstaDeep that was acquired as well. So there's exit opportunities that are outside what the traditional secondary type of exits most of us VCs were looking at. So that is one of the strengths that I saw a lot in 2023. The M&A activity really increased and continues to remain an option for companies to survive, to expand, and to exit as well. So I think that's one of the key things. Another thing is on alternative sources of funding. So you do have your traditional, can't really call VC traditional because we're still quite new. But then a lot of companies still were able to access debt funding as well, where typically traditional companies were able to do that prior, sort of asset-heavy companies. But now you can find that the debt funding available has increased as well. So I think in a nutshell or overall, yes, there had been a slump in 2023, but even data from Africa, the Big Deal, if you look at the comparison from 2013 to 2023, that 10-year period, there's been like 119x expansion in funding for that particular period. So it's not all doom and gloom. And I think it's important to also point that out in terms of looking at the larger picture and not as 1 year as a standalone.
Cool, thank you, Karen. Igosa, would you agree with Karen's strengths of merger and acquisition? And what's your experience been at Eco VC?
Thanks a lot for having me. So a couple of sort of adjacent observations. One of them is that if you sort of look at the cusp of the funding cycle and where, you know, you started to see some ignition, let's say it's 2015, let's just say it's 2015. It will mean that the first group of investors on the continent who would make investments will be 10 years in next year. If you do 2016, it'll be 10 years in 2026. So that usually is sort of the proper arc to measure cause and effect. And so, you know, and I agree with her to the extent that we we're sort of still playing with much shorter cycles for measurement. I think Dario had all mentioned that if you sort of look at the last 5 years, 13 odd billion, came in, of course, it spiked later on. It's definitely correlated to ZERP and then, of course, pandemic and the like. But it's 13 odd billion, which, in the overall scheme of things over a 5-year period is not a lot of money. So I think, and in that 5-year period, I think the opportunity set got bigger. So but what I think we had a big mismatch of was that because of ZERP, you had a lot more people starting companies that shouldn't have. You had a lot more opportunists. You had a lot more grifters. And so, we're going to find over the next 12 to 18 months that a lot of that 13 billion that got raised over the last 5-year cycle didn't really create a lot of value. Right. But what it did do was that it created a bunch of folks who were in the arena, I think, as Dario said, right, which is people who picked up, for good or bad, experience. And like my dad always used to say, you can only experience. You can't read it, you can't podcast it, right? So I think we're going to have, I think, a very interesting group of folks who have sort of picked up lessons, have picked up a lot of bruises, certainly in the last year and a half. And so I would probably argue that the last 5 years, the 13 odd billion was just in AI speak training data. And now we're moving to actual deployment models, which should be able to create a lot more value. Now, the challenge, which was always very predictable, in part because if you've been in the venture market and venture business as long as I have, and you've seen sort of economic cycles, you realize that a lot of the behavior of the foreign investors was so predictable. It was as predictable as the sun rising, right? The 0% yields allow people to take more risks. They empower people to take more risks in the search for yield, right? And what we then found was everybody kind of thought, oh my gosh, they love this market. And what it really was like, they're just looking for yield. And, the minute everything turned, they're like, oh, wait, we've got, we should really pay attention to things that are closer to home. And so I think, for us, if there's sort of a couple of material observations, one is that we are, when the US 2-year or 5-year or 10-year catches a cold or sneezes, we're going to catch a cold, right? And so we are so dependent on how people think of risks. And a lot of that is just going to be sort of what your riskless returns look like in the US. And there's a whole back and forth around, oh yeah, the rates are going to get cut and this and that. And so you can see this baited excitement, like, oh, we just need, it's almost like, you go into like a Greyhound race and you see how they act right before the gates open, right? Everyone's like, we're going to wait for these rates. And once these rates get cut, and the Fed look at you guys and be like, you don't know about all that stuff, we're seeing some strength in the US economy and all that good stuff. And it's an election year as well, which sort of means all bets are off. So, one of the things we used to do, and we seem to have gotten lost, and I'm hoping that we sort of get back into it, is become sort of not just more self-sufficient, and I think we're sort of naturally resilient, but also figure out how to be more collaborative, because no one's coming to save us, right? I mean, they come, they chat, this and that. No one's coming to save us, right? The stuff about how venture is moving to oh, you need to be profitable, I think it's all nonsense, right? Because venture has never been about trying to invest profitable companies. Venture has been always about high growth, right? Steep ascents, you can sort of figure out how to maintain growth at the expense of profitability for a while. And so you now see sort of this, almost schizophrenic approach to, oh, you need to switch from high growth to profitability. We used to be very good at that in Africa, right? We used to be really, really gifted at sort of never expecting there was going to be another dollar once the dollar came in, and figured out how to make that dollar, $5 or $6 or $7. And why I think panels like this are important, because we're sort of looking backwards now, but we really need to be thinking about looking forwards. Is that we're now in a macro environment that is unbelievably difficult for both founders and funders in quite a few countries in Africa, right? I mean, I'm sure you're following what's going on in Nigeria. 2 weeks ago today, I shared a tweet about how founders need to sort of go and completely recast their forecast for fiscal year 24. Because whatever it is, whatever exchange rate you used, I was like, look, I'm projecting an exchange rate of 1,950 naira to the dollar by the end of the year, right? That was 2 weeks ago. 2 weeks ago. So today, the last trade that I had heard of was 1554. So I'm sitting there going, okay. And when I sent out that tweet, it was 1336. So I'm like, look, by the time it gets to Valentine's Day, this thing might be at the 1950 that I thought, so I made some joke about roses are red and so and your eyes will be too. But, it just sort of, and you see challenges like that in Kenya and some of these big markets in Egypt. So all the big four that everybody keeps talking about have significant headwinds, right? And so I don't know if that macro even suggests that 2024 as a fundraising year will be anywhere even remotely close to even 2023. It's just going to be harder, right? And so, and then part of what I think I want to learn from this panel is sort of, what should founders be thinking? What should investors be thinking, right? How do you, how should they navigate what I call the Drake passage, right? Which is, as some of you may know, is one of the toughest sections of sea that a ship can go through. There's so much, right? And I think people are really looking for direction. And I do think that, anything that we see has happened in the past, we just need to sort of move past that and say, okay, what does the future really look like for venture and investing in Africa? And I think the final thing, just my final comment is that, Nathan, you talked about, I'm so physically ill when I think about what you said. For every dollar a male founder raised, a female founder raised 7.6 cents. Okay, so I think that a lot of the losses that will come out of the 5-year investing dollars that showed up probably has a direct correlation with the mismatch in gender investing, right? And that's another thing we need to talk about, because we have not really struggled with our female founders, right? And the businesses, they may not grow as fast, but you tend to sort of start to see what they can eventually become, which is annuity businesses. And that particular stat still is making me ill. But it's something that's worth talking about, because I've said this on the WhatsApp groups, things just need to fix, need to change. And doing the same thing over and over again and expecting different results is just a pill it's an insanity pill. And that needs to end.
Igloso, thank you. That was lots to unpack there, and thank you for that valuable answer. Dr. Ola Brown, firstly, welcome, and would you kindly introduce yourself? And also, my question to you would be to pick up on what Igloso was saying, is that on the gender diversification and investing more into women account for more than 50% of Africa. And just to add another stat to what you were saying, 1 in 4 women starts businesses and manages businesses in sub-Saharan Africa. So what needs to happen for more investment to go to female founders? Is it pipeline? What is it? Over to you, Dr. Brown.
Hi, my name's Ola. I'm GP at HealthCap. HealthCap is a firm that invests in two verticals only, health tech and fintech, and we focus on Africa's big markets in Nigeria, Egypt, Kenya, and South Africa. Nice to be with you all, and I'm looking forward to an interesting conversation. So the question you asked is mainly about female founders and how to get money to female founders. So I think the first thing that I'd like to point out is that actually Africa is the only continent in the world where a woman is more likely to start a business than a man. So if you look at Europe, men are more likely to start businesses. If you look in North and South America, men are more likely to start businesses. Even curiously, in Asia, where I thought, you know, a lot of particularly Chinese, Thai women start businesses, still men are more likely to start businesses. But in Africa, women are more likely to start businesses. So mathematically, it makes even less sense when you look at the statistics for female-founded businesses in Africa than it does in the rest of the world. And so how do we go about changing that? I don't necessarily think it's a pipeline problem because HealthCap was never a gender lens fund. So we never set out to fund more women than men or fund an equal number. We didn't have that as one of our sort of assessment criteria. But we still ended up with a portfolio that has 50% female founders. So I think it's about being very, and we were not intentional actually about looking for female founders. We weren't intentional about looking for female pipeline at all. It was just the deals that we thought were the best fintech and health tech companies on the continent. So I think that, you know, being aware of some biases in VC, and I'm going to cite a Harvard Business Review article that cites research that was actually conducted in Sweden, where when female founders came to pitch, they did the research and they asked the female founders to use exactly the same words and the same style of pitch as the male founders. But when they assessed the phraseology, for exactly the same phraseology, women were seen to be arrogant or overconfident, whereas men were seen to be, and I'll link for anybody watching, sorry for the people on YouTube, but for anybody watching here on Zoom, I'll link the study in the chat so you can have a look at it because it's so interesting. And for anybody watching on YouTube that can't see the chat, then I'll also put the study on my LinkedIn again so that you can have a look at it. But yeah, for exactly the same phrases, men and women were founders. For a Swedish VC, where it's very egalitarian society, were judged very differently. So I think that that's something that we all have to bear in mind in our industry. That I don't think it's a reflection of the type of businesses that women are building necessarily. I don't think it's necessarily a reflection of the resilience of those businesses because there's no evidence around exits, there's no evidence around sort of other metrics to show that women's businesses are less successful. But I think it's about the things that we hold in our mind and our assessment criteria. And I think some of these gender lens funds that are coming up are good because they have that as part of their investment criteria. But I think in order to really, really sort of exponentially increase the number of women coming through the pipeline, it can't be up to gender lens funds alone. And actually, I think that it's more important for everybody to be in the venture industry to be aware of the intrinsic biases that perhaps we hold when female founders come to pitch to us, and perhaps once we're aware of them, then we can start to challenge them internally, particularly with our investment committees, and maybe having sort of again, this is data from Forbes, where they looked at having a female investment committee member or having a female GP. Can you believe that drastically increases the amount of women funded? So a female GP is, I think it's 20 to 30% more likely to fund a female founder than if it's an all-male team, including the IC. So some of these subtle changes that we can make, and both of our external IC members are actually women at HealthCap. So I don't know whether that's contributed, but definitely trying to make these changes, maybe IC members, maybe even some of the LPs can start pushing us slowly towards a situation where we're not just funding sorts of companies because in order to fund the best companies, there has to be that level of diversity. I mean, if we're saying that women do start more businesses than men in Africa, then it makes sense that a greater proportion of the best companies, not necessarily female-led companies, but the best companies that are going to grow and are going to exit and are going to create economic growth and are going to create jobs are going to be female-led.
Thank you. Karen, I want to know from the Catalyst Fund and your perspective, is it just removing the bias, as Dr. Brown suggested, and also having women both sides of the table? What has been your perspective on this?
I think other than just removing the bias, I think it has to be an intentionality in how we make our investments. Our team is majority female-led. Our IC is majority female. I think other than the fund manager having more gender diversity, one of these that will be able to sort of move the coin on this is LPs actually having a requirement for their GPs to be able to deploy a certain percentage to female-founded or co-founded companies. For Catalyst, we have a 40% requirement that every 40% of our portfolio has to be female-founded or co-founded. We're currently at 35% and pushing to increase that to our minimum threshold. But I think it makes a huge difference, even speaking to some of our female portfolio companies. I think some of the questions that they get asked are ridiculous in different fundraising conversations. And male founders would never be asked the same, kind of questions. And as a woman, you sort of can see that because in different aspects of your life as well, you also get some of similar questions as you go about your day-to-day investing. So I think that it has to be very intentional. I think this one, LPs also have to play a huge part because it's still, and I guess I'm really happy you brought it up. It's actually still, it's one of those things that at this stage, at this point, I mean, is ridiculous.
Cool, thank you, Karen. In terms of sectors, so we saw that last year, fintech continued to attract the most amounts of funding with over $1 billion invested on the continent. Igosa, could you maybe walk us through which sectors do you expect to have the most amounts of growth in 2024?
Yeah, I think, some observations from sort of the sectors that we saw, there was just so much excitement in fintech over the years. And I think, those deals were getting written up, marked up very quickly. So everybody's sort of, in the classic sort of phraseology of why do you rob banks? Because that's where the money is, just, went and said, let's go rob some banks. But then, we absolutely got into this, trough of disillusionment regarding fintech. A lot of investors that had gotten super excited learned to their utmost chagrin that, one, it's actually more regulated than they thought it was. Or maybe they never thought about it. Two, it was going to be more expensive from a dollars raised perspective to get these companies to sort of, escape velocity. And I think a bunch of them just got fintech fatigue. We certainly saw it in our portfolio in terms of sort of follow-on financings because people just really stopped saying, well, they're like, hey, so we're seeing deals. There was one deal they had $200K in pilot revenue, raised, 65 million total at a 350 post. The 65 million, I think by the time they came back to market, 65 million in, they had generated like 1.3 million in revenue. And I think people just started saying, maybe that doesn't make any sense. Now, are the fintech opportunities? No. I mean, I still think that there's a fair amount of fintech that can be built. But again, the question is how much risk-adjusted growth can you fund these days? right? And and I think a lot of people are sort of really trying to pay attention to it. But other sectors, that's interesting. I think that everything sort of around climate is going to be a big deal this year. Certainly on the LP side, I think one of the things we're a little bit about is that there's going to be more money deployed into climate than should be able to absorb it. So there's going to be some concerns around there. Healthcare continues to be a very interesting sector as well. But again, it's healthcare and ed tech are very similar in the sense that a lot of the early, market feedback and a lot of the early PMF cycles don't necessarily represent the steady state. So you see a lot of very interesting things earlier and you think, oh, this thing is going to blow. And then you realize, oh, the engine has knocked. So part of what you're trying to figure out is, how do you get to steady state in some of these sectors? So healthcare certainly is interesting. I was on a call earlier on today. We talked about ag tech. To think too much as an investor. I mean, I'll be very candid, right? You're not going to be doing any kind of intellectual gymnastics with it. And I think, almost every other sector, struggles, with that because you actually have to do some diligence, right? Someone says, oh, I can, process X $100 million in TPV and be like, oh, that's great. Let's do it. What's the price? But I think we're actually going through this entire process now of how we're where things could work, where the gaps are in terms of sort of markets that have not been fully serviced. Everybody's sort of focused more on geographies, it seems these days, versus sort of sub-markets and sectors that haven't been fully serviced. And so as we sort of pay attention, we like entertainment. That's another very interesting sector. People always come. I think that's true globally, but that said, we still like it. You just have to be sort of very fussy about what you want to invest in. And then sort of finally, because we have some interesting things in media entertainment. But I think finally, what we would probably caution folks to do is really not how to serve the market, right? It doesn't matter what sector lens you're using, right? These founders, these products serve the market they say they're going to serve, right? Do they do it in a consistent way? I've talked about how a founder asked me, well, how do I know if I have product market fit? And I said, well, if your customer wakes up every morning absolutely petrified about the possibility that you're not going to be a business, you have PMF. And it feels like, a lot of what we should be focused on as investors is really trying to help these founders get to that stage, right? And like I said, we're sector agnostic. I mean, we might not actually do things like ed tech because it's, as you probably heard with Baiju's and stuff like that. Ed tech just has a ton of carcasses and I can't figure out what killed them, but there's a lot of them, right? So we're trying to stay away from that as possible because we're just not an abattoir. But it is, I think we're just very bullish. We'll see fintech, we'll do that if we like it. But we're very excited about some of the stuff we're doing in our eco fund, the latest vehicle we started. So things around climate, things around energy, things around mobility, some things around ag. We're very excited about that. And, and hopefully we can get more investors excited because I will say as a final point, that the reason why we started that Eco Pilot Fund was because we thought a lot of investors were not interested in those sectors. And as we continue to see, as we've started to deploy the fund, you know, more investors are just, you know, just not willing to do the work and are more interested in, you know, in tacking onto the momentum of fintech. And, you know, fintech's not going to say that, right? So it's all about that.
Thank you. Dario, would you agree that we should look at which markets to serve instead of which industries are expecting the most growth? Would you agree with Igosa?
I think it's been interesting to receive a lot of the feedback. And sorry for the camera, I keep hearing patchy sound, so I turned off so I can actually hear you guys. We receive a lot of feedback. Some people are like, you know, I suppose the guys at TechCrunch are very interested about Francophone Africa. Some people were interested in clean tech. Some people were interested in early stage funding. I think there's opportunities in certain areas, but one thing that maybe wearing my methodological analyst hat, something that I've noticed is for instance, there has been a shift, almost I would call it a gold rush towards the cash that was available for certain business models. And one of these has been, for instance, the lending model. Now, there have been companies like M&T, Alan, or Mancopa that were not historically lending companies, but they turn into lending companies to the point that we actually had to do a reshuffling of the data that we had, because at first, the first analysis of our data looked like clean tech and super apps were getting huge amount of money. And then when we actually looked into that, we were like, hold on a minute, like there's no hundreds of millions going into super apps. This is no longer the day for super apps. This money is actually being thrown into a model that has picked up a lot, which has been, and we're still a year waiting to see where it's worked and where it hasn't worked, and it just dried money into lending, for instance, right? So venture money and debt into lending. So instead of saying we should focus, I'm still in a phase where I want to wait and see. I think it goes to something that raised my attention. It goes to focus more on VC than Brighter. Brighter, I want to wear a hat of someone who focuses on access to finance in general. But because I mentioned market swings beyond the VC space, you know, depreciation, fluctuation, volatility that affect the markets. And so right now, what is happening is that we're still here trying to understand which markets are going to be resilient in this new phase, which markets are going to be able to make money, not excessively make money, but at least float over the next year or two, because it's true, like this economic condition is not necessarily going anywhere. And we're and more people are conscious about, first, the depreciation that is happening in Egypt, in Nigeria, in Kenya. Actually, Zach George posted in one of the investor group quite a few months ago this whole analysis of the depreciation. It was very striking to see in bulk, like seeing all these countries that have seen their currency depreciate over the past decade. And I think having all this said, probably having system thinking when analyzing the market is important, and can get a long way. And then again, I don't feel like giving predictions of which markets to focus on. I don't think I have. Yeah, I don't wanna do that.
Maybe
I don't want to be held accountable, because I'm the data guy, and everybody like, I already said it. Like, no, I'm not gonna say
it's a safe space. It's a safe space. But maybe I could ask the question with better, Dr. Brown. What unique edges do you predict for the African tech ecosystem in 2024? And don't be shy, you can meeting with us.
I've actually published all my predictions. So my blog post called Time to Build is my predictions on monetary policy. And so I've just put it in the chat. So all of my predictions on where monetary policy is going to go, where I think inflation is going to go, and the opportunities and the sectors I think are exciting. So I publish my yearly predictions every year. And, some time I'm right, some of the time I'm wrong. But yeah, hopefully, fingers crossed, let's see how the year pans out. But I'm number one. I'm sort of predicting from the American side, actually, that rates will be higher for longer. So I can see some of the things that sort of push inflation up. Some supply chain issues, particularly with the Red Sea, some of the geopolitical instability that just makes, inflation a more likely thing and makes rate cuts or rate cuts down to the level of zero absolutely impossible. In fact, in my article, I point out that interest rates have only been zero once in the past 150 years of interest rates. So I did an analysis of the interest rates across the world, in Europe and in America over the past 150 years. And actually, zero interest rates, people are like saying, oh, it will go back to the way it was. It's highly, highly unlikely. If something has only happened in the past 150 years once, then it's highly unlikely that it's going to happen again. So zero interest rates are actually a highly abnormal phenomenon. And actually, high. That's why I'm predicting that interest rates will stay higher for longer. Maybe not as high as they are right now, but definitely not going down to zero, which means that LPs will continue to have a more sort of broader look in terms of asset classes that they want to invest in. So that's the first major prediction. The second is around the future of work. So when I'll use the Nigerian currency, when the Naira was 400 to the dollar, we actually weren't competitive with an Indian of equal skill. So India was still the major outsourcing market. At 1,000, we are more competitive. So companies like Infosys, for example, employ over 100,000 people. The biggest employer in Nigeria, Dangote, employs 30,000 people. And it makes, Infosys makes about $20 billion in terms of revenue. One company from sort of future of work, outsourcing type work. That's half of the value of the entire Nigerian stock exchange. So I think at 1,000 to 1, we're more able to capture some of that value from outsourced work, particularly in a post-COVID world where people aren't so keen with people being in their the same geographic location. That said, unfortunately, there's also been this huge sort of AI revolution. So a lot of the sort of rote kind of repetitive work that was being outsourced from the US and Europe may be replaced with AI. So in the short term, I think the future of work is an interesting place to look at, and that cuts across sectors, right? So outsourcing across sectors. But in the long term, I think, these jobs at least may be replaced by AI, and I've put that in my prediction blog as well. So I do think I to be still right now it's talent is attractive, interesting, but there is a skills gap, and I think that for us to be useful in terms of outsourcing, then we need to fill that skills gap pretty quickly if we want to take advantage of probably the only advantage of currency devaluation. So that's quite interesting to me as well. Geopolitics. So one of the things that I kept on hearing was around reliance on foreign capital and over-reliance on foreign capital. And I think that is a problem, because by foreign capital we mean American capital. But what I also see, and I put that in the geopolitical section of my outlook, is the global base of power is slowly changing. I'm not saying that anything is happening to America as or the dollar is the sort of reference currency of the world. I'm not saying that, but I'm saying that I'm seeing a geopolitical shift towards the Middle East, towards BRICS, and I think it's really important for us to continue to leverage some of those relationships so we're not overly reliant on one single economy, and that we can diversify our sources LP commitments. And I know that some VC companies have already started doing that. So they've started looking to the Middle East as a source of capital as it continues to establish itself as sort of a financial center of its own. And I see that South Africa also has started doing some major transactions with the Middle East. I read about as the BRICS consortium are now, opening up signing multiple trade deals and opening up sort of markets to trade amongst themselves. And I think it's important for sort of us to have options in terms of LPs as well. So we're not overly reliant on that market. So domestic capital, yes, I think that that's very important. I think alternative sources of capital as well, really important. But from the founder perspective, I think what's more important is actually building or trying to build in sustainability into the business model. So you're not raising necessarily to survive, but raising to thrive. So knowing that, I can raise capital at the time I want, but not out of desperation, because when you're raising out of desperation, because I've got like 2 weeks of runway left and it's going to fall apart, then it's a very vulnerable situation for any founder to be in. And usually you don't get the best terms when you're doing that. So really planning fundraisers, but planning towards sustainability as well. So you can sort of have more choice in terms of the type of deals and type of capital you take. And I also think that even though in healthcare, at least, while things are going, badly for most LPs, Eli Lilly, Nordisk, all of the big pharmas. I mean, when I was doing medical research 10 years ago, I didn't think that the biggest blockbuster drug would be an obesity drug. I really thought we'd have cured cancer by now, or cured Alzheimer's, or cured dementia, but it is what it is, right? Eli Lilly and Nordisk have become the biggest companies on their continents, respectively, due to these new obesity blockbuster drugs, right? So they are great sources of capital for health techs because they're strategic, but also for LPs or funds that invest in health tech. So that's really interesting as well. So while traditional sources are drying up, some corporates are doing really, really well. So looking to strategic corporate capital is also something that I'd advocate, and quite a few of our portfolio companies have been able to successfully raise from corporates that compared to sort of maybe family offices who are diversifying more into fixed income, and compared to some of the HNIs that also want fixed income, or they're piling into private credit because private credit is really hot right now because of the interest rates, of course. The corporates are really looking for innovation. They're looking for the next growth. They're looking for a pipeline, and they're looking for strategic partners, and they're looking about how to digitalize their business models further. And that might be an interesting source of capital.
Perfect, thank you.
Right size, of course.
We are running out of time, but Karen, I'd love to also know your predictions for the year to come.
I'm not going to do any predictions. I'm just going to say where, as Catalyst, what we're looking forward to seeing for the year to come. As I mentioned, we are climate tech investors and looking at different verticals within climate. So fintech for climate resilience, sustainable livelihoods, and essential services. So some of the sectors that we would like to see a lot more sort of pipeline from. Of course, our pipeline is very heavy on ag tech and Egosa. I know the challenges around agriculture, but it's one of those sectors where it drives our continent in terms of provision of food, jobs for the smallholder farmers and all of that. So we're still going to be focused on ag and looking at different applications of agriculture and how technology comes in. I think one aspect of this is just understanding that fintech has had its time. I think even at Catalyst, we used to be a fintech-focused accelerator fund, now shifting to climate. But then we're looking at now solutions that can embed fintech within some of these verticals that we have mentioned, understanding that tech cannot be the only business model that you're driving within the continent. If you're looking at healthcare, purely health tech companies are not really doing that great on the continent. Looking at a hybrid model where you're able to have both physical clinics and healthcare platform online as well is one of those things that we're looking at. So healthcare is one of those that we're very interested in. Insurance solutions as well that are providing buffers for climate events. So disaster relief insurance, crop-based insurance relief, weather-based indexing insurance as well. So any income protection startups that are able to provide that buffer for communities. That's another area that we're really excited about. One other one that we are also, actually this particular one, if we can find that this year, we'd be very happy, is in the data space, something similar to a mini that came out last year. So something in data that is able to better price, the risk of these climate events, for example, you're more sort of predictive as opposed to reactive. So healthcare, insurtech, water is one space as well that, given the space that we operate in, there's a lot of challenges in terms of water scarcity and availability of water, and that really depleting. So looking at smart ways of managing existing water resources, smart ways of monitoring those resources, and having a more predictive response towards any anomalies within that provision of water. So we're looking at a variety of things, but then those are some of the key areas that for this particular year we're trying to see more innovations coming out. Another diversification as well is trying to see, other than the big four countries that all of us are sort of concentrated on, including Catalyst, where else can we focus our investments on? So you've got your Kenya, Nigeria, South Africa, Egypt. Looking outside those four countries, we've got investments in Tanzania, in Morocco, in Senegal. Where else can we go? Benin has come out as a key player as well. I think they're now in the top 5 in terms of funding deployed for 2023. So looking at other markets outside just the main areas of concentration, so that you can diversify your portfolio as well in terms of effects on currency devaluation that we've seen in Egypt and Nigeria. Kenya is also coming up in that as well. So that other Francophone, I think, is less affected by currency devaluation because of controversial, ways of how the currency also operates. But also looking at diversification from a geographical perspective is one of those. I think we need a lot of sort of patient capital deployed in the sector especially for climate type companies. And so looking at attracting a lot more capital from an LP perspective, from a more diverse LP perspective, from local investors as well, and then looking at that diversification and geography, and then the pillars that I've mentioned as well. That's what we're looking forward to for 2024.
Perfect. Cool. Thank you, Karen. I'm just going to read some questions from the chat. So the first question would be, what do you guys look out for in founders doing pre-seed and seed rounds? So if anyone could kindly answer that. Igosa, could you answer?
Yeah, it's a great question. One of the things we've been going through, sort of the internal review has been sort of to test and retest the assumptions over the last decade about the types of founders we want to back and what they show, what they signify. And we've run into, I think, a bunch of founders, I think, certainly through ZERP, that were, raising money, as Ola would probably say, to Japan, do other things and run lifestyle businesses. And we're not in the business of supporting those types of founders. So I think I've been using this sort of internally for a while, and I probably can share it publicly, which is that, we're really looking for founders with high agency, right? We've also figured out very quickly what kind of investors we are. And then now really so trying to spend time figuring out which founders match our investing style and, best, We're not nannies. We're not going to sit down there and and offer daycare services. We're not that type of investor. You certainly know me. I don't have time for that nonsense. But founders with high agency seem to do really well with us, right? And we seem to do really well with them. So that's going to be, I think, a key thing, right? Founders who are not sitting there and waiting for venture dollars to come and sort of allow them to pursue their mission, or their vision. And then, and then founders who've done the work, I say this all the time on social media, have you done the work required to form an opinion? So if you come in and say, oh, I want to build a product, or I've done this or done that, we're not really good at those types of founders. What we're really good at is, I had a hypothesis, I built an MVP or whatever it is, I went out, I tested in the market, right? I can get only one out of 10 people to pay for me, but I think I've cracked the code. I found a secret, right? We love founders that discover secrets, right? And that's going to, I think, something we're absolutely doubling and tripling down on. Founders are high agency, founders have discovered secrets, founders that are sort of willing to do what it takes to build a world they want to live in and they want to operate in and they want to support, versus those that have sort of read the most recent sort of thing in, on TechCrunch about the raise a seed fund in Asia, on Europe or in the US, and goes, oh, I want to build something like that. And they go sort of copy the tech of that. So we're certainly not interested in copycat founders. We want founders that have created, have innovated and done the work required from an opinion. They have an opinion. That opinion is expressed in the business model, is expressed in the product, expressed in the market. And I think most importantly, one thing we're absolutely not going to compromise on is we're not going to be investing in founders that have any disdain for the target markets that they serve. We see that a lot. We're not doing that. No. There we go. When I'm going to do some Africa on my way to go and do something in the US. No. If you don't really care about serving these markets and deeply care, then don't start.
Cool. Thank you. Dr. Brown, what do you look for in founders?
So this might be a bit of a controversial point, but we're very market orientated. So the first thing we do is actually try internally to assess the type of market that the founder is looking at, because I think that I've always been of the belief, and again, people on the panel may have different opinions on that, but I've always been at the belief that it's better to have even a mediocre founder in a fantastic market than to have a very, very good founder and just no market. And sometimes you have like absolutely brilliant founders, like I'm sure you all know the story of the Nobel Prize winner in finance that started a hedge fund. And his hedge fund was actually so record-breakingly bad that it was the first hedge fund that had to be bailed out by the Fed. Now, if you want a Nobel Prize in finance, you should know about finance, right? You should be like, exceptional, a top 5% founder. But he just wasn't. And I don't think he sort of had a right understanding of the market or building algorithms, or maybe the quant. I don't know what the problem was with the business model, but obviously it wasn't the right business. But the same founder with a great business probably would have done okay. So we always look very deeply into the business model. And obviously, because we only invest in two sectors, and most of our analysts have worked in pharmaceutical companies or have worked as doctors or have worked as lab scientists themselves and have worked in the industries and operated in those industries before transitioning into VC. We know those industries really, really well. I've built a healthcare business before. I've left the healthcare business before, divested, got a liquidity event. So and my business operated in 40 countries across Africa. So I know what it takes to build a healthcare business in Africa. And for our fintech operators as well, the same. So we're always trying to assess the market and saying, this might, what is the size of the market? And then after making sure that the size of the markets and the market that they're sort of going for makes sense, then we start looking at the founder and saying, what are the unique characteristics of this founder? Have they worked as an executive in this sector before? Do they have track record in terms of what starting a business before? How did that business go? What's the structure of the team, and what are the unique skills of the team that they've put together? And how capital hungry is this business? Particularly in the fintech space, are they going to need licenses? Are they going to sort of need to go through compliance processes for every country that they go to, etc.? So we're looking at, how flexible sort of business model is and how capital hungry it is as well. But the first thing we're looking for is this a big enough market? And I'll post my video on market size and consumption in the chat as well, because I talk a lot about really, really thinking about the market and thinking about how big the market that can buy your product is. Because, I think that a lot of people that go to build a business see a gap in the market, but there really, really, really has to be a market in the gap as well.
Perfect, thank you. Dario, would you agree? Is it market first when you're looking at investing in founders?
I think what we've seen especially in the last couple of years is there are a lot of good companies out there, and I like what because it was saying agency strong founders. I think the concept of moat, the concept of having a specific competitive advantage is very important when building pioneering businesses across the continent. And so I think there are a lot of actually the point I want to make, inspired by Karen, maybe I know making prediction and maybe explaining what I think we will continue seeing based on what we're observing, is there's a whole new cycle of a whole new hundreds of companies at the early stage that were not even present when the bubble happened and burst. So there's a whole new generation of companies that is out there that is reminiscent of all these lessons that have been learned in terms of being careful with valuations, being careful with which type of funding they go after. And I think this is a massive opportunity for the ecosystem to leap into a new chapter. One of the findings of this year's Brighter report was that the funding activity in terms of numbers at the early stage has actually kept growing over the past few years, right? Where the contraction has happened at late stage. So this is actually, and also thanks to funds like Catalyst Fund, right? There's a lot of funds that now have doubled down on their cohorts, and they all are early stage, and they're looking into young companies that have just started their growth cycle, right? And so I think this represents a massive opportunity, and it's something we keep seeing. And ever since I've started Brighter, I've said that every year, one consistent aspect that we see is the process of maturity of the ecosystem. And so I think as the process of maturity brings with it a lot of questioning of models, a lot of questionings of best practices, a lot of questionings of what was right, what is right, what's wrong, and what to do and what not to do. And so I think the new generation of companies, coupled with the new generation of early stage funds that is also specializing in very different sectors, which is something that wasn't present 5-6 years ago, plus all the hard learnings of the last couple of years, these three factors represent an excellent cocktail to be positive about the future. However, we do need to remember that the macro conditions are still pretty wobbly, and so we'll have to be able to navigate the world, but also being conscious of the fact that there is a whole new generation of hundreds of companies that is coming to the market, and many of these companies could represent the next $1 billion or anyway the next $100 million company. I think this is a note I would like to end with on my end.
Cool, thank you, Dario. And Karen, finally, if you could give me 3 things that you look for in founders at the Catalyst Fund, what would they be?
Yeah, sure. So first of all, we very rarely invest in a solo founder. So we usually prefer to invest where there's at least one other co-founder. And in looking at that, we look at then the complementary skill sets between the co-founders together. So if one is typically quite strong on the tech aspect of the business, then it would be important to have someone else who's very strong either on operations or the business development side of things, and the tech resource can focus on what they're strong at. So that's one, it's a complementarity between the team of founders. Another one is, of course, knowledge of what it is you're trying to execute. So relevant expertise within what it is that you're trying to solve or to set up. So if you're, for example, in a health tech, it would be important to see someone at least with the medical background within the co-founding team, or something relevant in that sense, in terms of perhaps medical systems, medical records, and that someone who has an understanding of the healthcare system. If you're looking at, we have an investment in sort of very technical direct air carbon capture. He's built a team of experts around who have that very technical expertise within that carbon space. So very relevant expertise is important to us. And so it's very rare as well. I think we haven't yet invested in a first-time founder, say straight out of uni, who's like really just starting off their career as a startup. So an experienced founder is another thing that we look at. There are some soft things we look at because of the model that we operate. So coachable, you can pivot when it's necessary. very responsive, very clearly you're able to articulate the business that you're trying to build. And yeah, general, passion and grit that you're gonna go through the hell that there is in running a startup. Yeah.
Perfect. Thank you, guys. Thank you. Thank you for your time and your valuable answers on this panel. And I would just encourage all our viewers to go back onto YouTube and rewatch this, because there were so many golden nuggets. And if you really paid attention, there was things I certainly learned a lot. So thank you for that. Nathaniel, back to you.
Like Nathan, I will take over. Thank you so much for everyone to have joined. I'm going to share now. Again, we are at Johannesburg in April. Sorry for my voice. Mark the date, 23 to 24th of April. And I'm just going to share the slide now to announce that the report is on the website. So you could go and actually download or check what we have been doing. And yeah, have a wonderful afternoon, and see you next time. Bye-bye.
Thank you, everyone. Have a lovely day. Bye.
Thank you.
Thank you. Thank you very much. Bye-bye.